You don't need to have an opinion of gold. You don't need to forecast gold price. You just need to understand that the way the world works, the scheme in which you have invested. I challenge you, can you get the portfolio within 30 seconds or within 1 minute? You will have everything in your mailbox except for a product note or the portfolio of the scheme in which you have invested. When the NAV is going up, you have trust in the system, you have trust in the fund and the fund manager. When the NAV is going down, you don't trust anybody.
Hello and welcome to the Beyond Return podcast. So today we are joined by Aashish Somaiyaa, the CEO of WhiteOak Capital Asset Management. Aashish is one of the few leaders who have successfully scaled 2 mutual fund companies from ground up. This is a rare feat that demands not only business acumen, but a very deep understanding of how investors think, behave, and sometimes go wrong. In this episode, we are going to explore 10 powerful investing principles. Now, these are insights that every investor should know to build and sustain long-term wealth. So let's dive in. Hello, Aashish, and welcome to the show.
Thank you, Dinesh. Thanks for having me.
As we've discussed, the topic of the show is 10 principles that investors should live by. Where do we start from? So, which one is your favorite, or which one is the one that you think is the most important principle that investors should keep in mind, and that's something that they should live by?
So difficult question, but if I have to single out one, then I will say that, not to be with the herd or not to be with the crowd. Because what happens is that the biggest mistakes are made when, people are trying to do what everybody else is doing. I think so, staying away from the herd, staying away from the crowd, being a bit contrarian, like in Mumbai they say, thoda ulta khopdi hona, that is very, very important. That prevents mistakes actually.
But I've read in many of your articles in communication that you often emphasize that successful investing is all about being open-minded and being probabilistic. It's also about not having absolute clarity. So what investor behavior make you say this? And when you say thinking in probabilities, what does it practically means?
Sure. So, see what happens is that, let's take certain examples. Okay. India is obviously a cricket-loving country, and I presume a lot of your audience will also relate to cricket. Now, and I know Dinesh, you also lived in Mumbai. So you'll appreciate that in Mumbai, obviously, most big matches happen in one kid. So let's take an example that you and me have to, play a T20 match. Let's say you are the captain, I am the vice captain. And I come and tell you that, match is in one kid. And you know that in one kid, 200 plus is the par course in a T20 match. So I tell you that let's do one thing. When we go to the ground, we'll win the toss and we'll elect to bat. And the match starts, we're going to hit 400 runs. Okay, we'll take first batting. We should knock them out. We should hit 400 runs first up. So let's do one thing. Let's go with 9 batsmen. Okay, let's do it this way.
Okay.
So we are prepared, we are all set. And that there is a pre-match discussion. And then I ask someone that, okay, we are all set. What do you think? How is the match going to shape up? Now, what would the answer be to such a question?
We don't know.
The point is that there will be no match. There will only be toss. Right.
Correct.
Because if you make your cricket team saying that, this T20 team should have 9 batsmen, okay, and we should go to the ground, elect to bat, and we should first up hit 400, take all the risks. So when we land up on the ground with 9 batsmen, what's the first thing that will happen? The first thing is that we are going to lose the toss, right? And the opposition is going to elect to bat. Now we have no bowlers. So opposition will hit 500 runs to us, against us, right? So the point is that, why is it that when you watch a T20 match, why is it that a T20 match, every T20 team has 5 to 6 batsmen, 2 or 3 all-rounders, 3 or 4 specialist bowlers, and the wicketkeeper is always a good batsman?
True.
It's always like this, right? And +1, -1, it might happen depending on somebody has good batting, good bowling, the pitch, etc. But ultimately, each and every T20 team is exactly the way I said. Why is it that you never find a T20 team which goes with 9 batsmen, 1 specialist bowler and 1 wicket keeper? Why does it happen? Because cricket teams are never made assuming that we will win the toss. Cricket teams are never made assuming that Wankhede will behave like Wankhede and not like Chennai, Rajkot or Mohali. Right? So whether it's a cricket team or a soccer team, any other discipline in life, we always strive for balance. We always build our teams knowing very well that we may win or lose the toss. The pitch may behave as expected or behave like some other pitch altogether. Our opening batsman may perform or may not perform. Correct. So same way, now you look at markets. Correct. In markets, what happens is that the most widely prevalent conversation is what do you think is going to happen? What about Mr. Trump's next tweet? What do you think he's going to say next? But look at it closely, Dinesh. If you see in the last 1 year or even the last 2 years, you look at mutual fund industry itself. Anywhere in the range of 60 to 70% of the net inflow is going into small cap fund, mid cap fund, sector fund, thematic fund. So people are investing that way because they have very high return expectation. They are thinking that the bullishness after 2020 and 2021, they must all get high double-digit returns. So people have already assumed that large cap doesn't do great. In the past, balance advantage funds and hybrid funds were the top of the town, but nowadays, no, right? It has been for last 3 years, it has been small cap, mid cap, sector and thematic, correct? Now, your portfolio is, let's say, 60-70% sector fund, thematic fund, small cap and mid cap. And the sector and thematic is also defense, railway, infrastructure, PSU, energy, power, right? So this is the portfolio. And then I come and ask you, Dinesh, what I'm really worried, what will happen if Mr. Trump makes some new announcement? So you'll say, boss, you look at your portfolio, the risk is in the portfolio. Risk is not in Mr. Trump's tweet, risk is not in the market. Your portfolio, you made your portfolio assuming you will win the toss, right? There is no scope for any eventualities. So this is the reason why I always tell people that, your portfolio should be, you may have a worldview, you may have a preference, you may have a return expectation, all that is fine. But what is the reality? The reality is that from its high point, every year once, the Nifty declines anywhere in the range of 10 to 20%. Every year once, from its high point to low point, the small cap index declines 15 to 30%. And every year the reason is different. So, there is only one certainty, which is that the market will decline for different set of reasons every year or 2 years. And it will go up in line with fundamentals or some macro changes. So that's why I say that, portfolio should be made with a probabilistic mindset. You may have your preference, but there should be enough scope for eventualities in portfolios.
So if I'm an investor and what you just said I want to implement into my investing, so how do I go about it? When you say it's think in probabilities, how does that practically translate into investing or making a portfolio?
So, look at it this way, like currently where we are is a great case in point. We are, say, lot of people have seen market going up and a lot of people have seen market going down. But right now is a peculiar juncture where for maybe 12 to 14 months, market is going nowhere. So people have seen it going up or down. Not enough people are there who have seen it going nowhere. It makes people nervous. But see, where is the dichotomy? In 2024, when the Nifty was 26,200, what was the environment? The environment was tight liquidity, high interest rates, kind of 5% GDP growth forecast, literally 0% corporate earning growth, right? And all, myriad set of conditions, which, the government was maybe, busy just coming out of election, coalition politics, so many things in 2024, correct? And of course, the uncertainty related to Mr. Trump's election and what he will do, etc. So 26,200 in the year 2024, this is what the makeup was. 25,000 level, 12 to 14 months later, government's fiscal policy has changed. We are talking tax cuts and GST cuts. RBI policy has changed. RBI has cut interest rates, pumped in liquidity, and RBI is doing all it takes for banks to create credit. Changing even regulatory guardrails, correct? Forcing, literally pushing banks to lend. India's GDP forecast has gone from 5.4 to 6.9. Sovereign rating has been upgraded. Whatever Mr. Trump had to do, he has already done. Now there is no suspense. We know it's out there, correct? And the market has digested all of that and not given us any big bump. So you can see market is at same level. 1 year back, what was the condition? Today, what was the condition? What is the condition? 1 year back, people were queuing up to buy the next particular sector fund or thematic fund. And today, there is some kind of trepidation that nervousness, trepidation and nervousness that, what will happen now. So see, this is what happens. When people are supposed to look for risks, they look for opportunities. When people are supposed to look for opportunities, they suddenly start smelling risks. So this is what I mean that, probabilistic thinking, it's all about calibrating. See, when you mix up both the things we spoke till now. One, I said you have to be away from the herd. And second, we spoke about thinking probabilistic. They are actually intertwined. They dovetail with each other. Because the point is that if you see, you have to think probabilistically, meaning what? That last year, when there were clouds on the horizon, but everybody was going gung-ho, you should kind of, step back. And today, when everybody is expressing concerns, now everybody is saying instead of small cap and instead of buying equity, now everybody is worried about, oh my God, shouldn't we buy gold now or should we buy silver? So look, that's what happens. 1 year you get a zero return. That's when you start getting all these thoughts that last year I should have kept money in the bank. Last year I should have kept money in gold. So I think, calibrating the portfolio opposite to how your emotional, thoughts are. Thoughts and emotions are. I think that is extremely important, and it's not easy. It's easier said than done. How do you consistently execute away from what your emotions are making you feel? It's not easy, but the thing is that you need to ensure that your portfolio has a good asset allocation. Meaning eventuality. Look, 23-24, everybody was just queuing up to invest in equity. And gold, people used to say, like I have experience, in 2023, we launched a fund which had some nearly 25% in gold. And people used to say that, gold makes no return. All the return is in equity. You are going to underperform. Correct. Now that fund has calibrated gold all the way down to 10%. And people are asking, why are you reducing gold? So I said, look, I can't work with your feedback. I have to work with a model. 2 years back, when we had more gold, you were saying equity will go up. Now that we have increased equity and reduced gold, now you are saying, why are you selling gold? Why don't you buy silver also? So this is the whole issue that, people, they will watch, they will read what you write. They will watch what you speak. They will try to collect a lot of knowledge and information. But ultimately, last 1 year momentum and the recency bias, it overshadows all the wisdom, knowledge, and information that is being dished out.
We just spoke about probabilities, right? There's another thing that you usually speak about, that is having a healthy relationship with uncertainty, right? Which I think are also two connected things. So we understand that investors always need closure and they need certainty, right? But as you put it, they should have more of a healthy relationship with uncertainty. So how can somebody do that? How can somebody actually build a healthier relationship with uncertainty as an investor?
So here also, I think, the best example, sometimes, we are blessed to be in this country because great examples can come out of Bollywood or cricket or out of food, actually, if you ask me, right? But if you see what happens is this, like say, Dinesh, that, in the recent times, cricket has been top of mind. So let me pick on that. Let us say that there is an India-Pakistan match. That is one option you have. And there is England versus Australia playing the Ashes series. Now, let me ask you hand on heart, if you're a connoisseur of good cricket, if you're a cricket enthusiast, right, which match are you, and obviously you are Dinesh, you are Indian. So which match you are likely to enjoy as a connoisseur of cricket? Somebody who's interested in the technicalities of the game, and somebody who is interested in observing sheer performances, which game will you enjoy more?
Test cricket.
England, Australia, Ashes.
Ashes, yeah.
As in, right? Because see what happens in an India-Pakistan match. In an India-Pakistan match, what happens actually is that you are absolutely and fully invested in the outcome. See, there are many times, when India and Pakistan were playing, we knew that, look, Wasim Akram and, Shoaib Akhtar and, Imran Khan, of course, right? We knew that, boss, it is the best pace attack. Waqar Yunis is the best pace attack in the world. But there is a Virender Sehwag standing there and mindlessly flashes his bat outside the off stump. And it goes for a 6. Right? And you clap. Now look, boss, you know that that's a fluke. Right? He's just flashing his bat hard and the bugger is bowling at 150 kilometers per hour. So either you are caught behind or you are sixer. Correct? But you don't care. You don't care. You clap for the 6 because you want India to win. You're not concerned. But look, instead of that, if it was England and Australia, right, and it was Glenn McGrath bowling, and somebody flashes the bat like that, you will feel disgusted. You will say, boss, this guy is the best bowler in the world. And there is some guy out there, who's not at all technically sound. His feet are not even moving. He's just, flashing the bat. I mean, he doesn't deserve a 6. He deserves to get out on this delivery.
True.
So what is the difference? The difference is that when you're emotionally involved, you only want India should win. You don't care for the technicalities and nuances of the game. The nuances of the game, the technicalities and the quality of the players, you will enjoy if you're dispassionately, unemotionally watching maybe England and Australia or, some real, matchup. Correct? So what is happening? Why am I giving this example to you? The reason is basically that people want certainty. People want closure. Boss, if India and Pakistan are playing, you forget all the plan. I want India to win and I'm only concerned with India winning. One good delivery is bowled. I'm like, oh wow, we will win. Next delivery, the guy hits a 4. I'm like, why is this bowler in the team, man? I mean, are disgusting here. This team selection is pathetic, right? This is all, nepotism and, we're just picking all the wrong guys. So that's your reaction. Every delivery you're pronouncing winner and loser. You just can't bear for the game to get over. Now you draw this with investing. What happens in investing? See, in investing, we know that over the last 30-35 years, our compounded history is 14% compounded. Since India's liberalization, Sensex is probably 14% compounded. But while delivering 14% compounded, literally every year from the high point to the low point, it declines 10, 15, 20%. There's no year where index doesn't decline, right? I mean, some years less, some years more. So what happens is that we all know that in the long run, if we can tide over this volatility, if we can stay away from pronouncing winners and losers, and if we can merely bring ourselves to enjoy the game, then we all can compound our money double digit. But we are not able to do it. Why? Because every time market goes up and every time our recent return is good, we have very high conviction. We feel my portfolio is great, this fund manager is great, my advisor is great, Dinesh has given me great advice, everything is fabulous. 6 months later, if the portfolio is 15% down, what will be the reaction? We start pronouncing losers. This fund is not good. This fund manager didn't book profit at the right time. I'm watching so many advisors. Nobody told me to sell at the high point. And so when the NAV is going up, you have trust in the system, you have trust in the fund and the fund manager. When the NAV is going down, you don't trust anybody. Why that is happening? That is happening because you're losing sight of the journey. At every left turn or right turn, you are busy pronouncing winners and losers because you just can't tolerate the uncertainty. But look at it this way, that if you keep faith in the longer term journey, if you keep faith in the fundamentals, the economics and the maths, and you don't let your emotions cloud, if you can prevent your emotions from this urge to declare winners and losers, right? And if you can bring yourself to enjoy the journey or enjoy the game, not only you will enjoy more, you will become a better investor, you will actually make a higher return and higher impact on your wealth. So it's very, very important. See, like, you keep score. See, keep score. Sometimes fast, sometimes slow. Matches and stock markets, they progress like that. You keep score, but refrain from the urge to declare winners and losers, because the moment you pronounce something as a winner or a loser, you have an urge to act on it. You have an urge to do something. But if you just keep score and say, okay, right now it's not looking good, let me revisit later. Right now it's not looking good, let me revisit later. It's looking too good, let me revisit it, right? So if you keep track, you enjoy the nuances, you'll be a good investor. But if you, instead of just keeping track or keeping score, if you insist, this is good, this is bad, this is right, this is wrong, this is left, this is right. Like, we always say that life is gray. That statement is also about adapting to uncertainty. Whereas actually human beings do very badly when they're faced with uncertainty, right? I mean, we want to classify people as good people or bad people. We want to classify circumstances as good or bad, right or wrong, left or right, correct? And we want to classify everything as, black or white. My son is 6 years old. He was asked me, Papa, what is blacker than black? And what is whiter than white? So he's 6-year-old, so I had to give him some answer. But how do I tell him that, beta, there is no whiter than white or blacker than black? Actually, real life, everything is gray. There is not even much of white and black. So that is relevant for investing, for business, for life, for everything. Human beings cannot adapt to uncertainty. But for everything in life, it is very important to adapt to uncertainty. One quote I'll tell you, it's attributed to F. Scott Fitzgerald, who was, a great American thinker and philosopher. He said that the sign of first-rate intelligence is the ability to hold contradicting ideas in your mind and still retain your ability to function. So if you can watch a match stoically without pronouncing winners and losers, only then you can actually enjoy the nuances of the match.
In fact, this one analogy that you just mentioned about, declaring winner and loser or having a comment on every single ball is going to stay with me for a long time. That's really quite an analogy. And that's how even I think, and that's how many investors also think. If the fund is not doing well for a period of 3 months, or if I'm investing in index and it's not doing well, then suddenly we think, this is not going to perform.
If a fund is not doing well, there will be many junctures that's not doing well. But the point is like this, look, if it is doing well, you need to understand why it is doing well and in what scenario it will start doing badly. If it is doing badly, you need to understand that why it is doing badly and what needs to happen for it to start doing well. And then you need to see that, is the fund dependent on the fund manager's stock picking and portfolio construction, or is it just blowing with the wind? This fund was anyway holding PSUs. Now PSU is doing well, so the fund has also gone up. Somebody was always holding pharma, digital and consumer, and then there is COVID. So okay, in COVID, so what happens if you see in fund management, performances get tailwinded and headwinded when the macro environment changes. Correct? But who is a consistent performer? Somebody who delivers alpha purely from stock picking, and under any circumstance, the portfolio doesn't get overly headwinded or tailwinded. Correct? Because whatever alpha you get from a macro tailwind, or whatever alpha you get because of change in circumstances in the environment, that alpha the market will snatch it back from you. But any alpha you get just by superior stock selection, irrespective of headwinds and tailwinds, that alpha is a function of skill that will remain with you. That's why I said that, even for funds, before you start pronouncing winner and loser, I just give an example. This kind of analysis needs to be done, that when he did well, under what circumstances he or she did well. When they did badly, under which circumstances are they doing badly? How much of the good or bad performance is because of poor stock picking, and how much of the good or bad performance is because of just change of macro environment and circumstances. Is the portfolio so imbalanced that under one macro circumstance it is number 1 and another macro circumstance it is number 30? Right. So all these things need to be really looked at, and that's why I said you can do this only if you are a dispassionate observer. You cannot do this if you're busy. If you decided that this fund is bad and then you will look for data to prove that it is bad, right? It becomes a confirmation bias. If you decided that I'm in love with this fund and this fund manager, then it is again a confirmation bias. So what I'm saying is difficult, but you need to be balanced and you need to be unemotional and you need to be fair. Not somebody who's already arrived at conclusions.
In fact, I have this exact relationship with Nifty Next 50 index fund in which I invest. So it does really well for a period. So last year it did really well, right? But this year it hasn't. And this is the relationship I have with this index for about maybe 7 or 8 years. So I can really relate to what you're saying.
So actually forming a relation with the investment is also an important thing. And I'll tell you this, like in our, just take it as a joke, take it on a lighter note.
Sure.
One of the things which I observed in our industry, which I try is that my fund house overcomes. One of the things you must have observed that, Kinesh, if you invest in XYZ fund of ABC AMC, so when ABC AMC launches a new fund, has a change of TER, has a change of key management personnel, witnesses RBI policy, government budget, elections, Mr. Trump's tariff policy, change in regulations, everything. For everything, you will have an email. So, from ABC AMC, will send you their entire fact sheet, every NFO launch. They will send you everything. The scheme in which you have invested, I challenge you, can you get the portfolio within 30 seconds or within 1 minute? You will have everything in your mailbox except for a product note or the portfolio of the scheme in which you have invested.
Is this something that usually happens?
I have observed it.
Okay.
I'm from the industry. I observed it.
You're from the industry, so is this something conscious?
No. I'm saying I'm saying that how I'm telling you the counterpoint. Like you said that you have a relationship with Nifty Next 50 fund. So I was saying that it is very important to form a relationship. If you want to understand in a dispassionate manner, it's important to form some understanding, right? The problem is that in our industry, we end up sending everything to Dinesh as an investor, except for sending him stuff on the very scheme that he or she has invested.
Got it.
Right. So if you're invested in a particular scheme, you will get all kinds of emailers for everything which is launched, every TER change, every management personnel change, every budget and monetary policy, and you'll get everything. But the scheme in which you have invested, if I challenge you that get me the portfolio from your mailbox in the next 1 minute, chances are you will struggle.
100%. I might be investing in about 4 fund houses, and I don't get their monthly portfolio disclosure in my mailbox. So what you're saying is true. Even I have observed that.
Yeah, you will get lots of mailers, but there will not be one pointed mailer saying, "Dear Dinesh, thank you for investing in this fund. Here is the latest portfolio and the update."
100%. So great analogies, great way of explaining things, and that's actually bring me to my next question about visualizations, right? So you have this knack of describing in analogies and also using very powerful metaphors, right? So I remember reading about spring action, market being a pendulum, then describing and using an analogy of car wipers, elevators, right? So just want to understand when you use visualization, right? You've also talked about why visualization is a great tool for investors. Can you walk us through these models, how investor can use visualization in their investing?
So, Dinesh, it's a well-known fact that, sometimes what happens is that simple concepts are articulated by highly intellectual people. And then obviously when they articulate at their level of, expression and intellectuality. So let's take an example, like, there's this concept of multidisciplinary thinking. right? Or let's say, for example, Mr. Charlie Munger, he said that to understand, stock markets and to understand market phenomena, you need a lattice work of mental models. See, basically, this is all about having the right metaphors and the right parallels. Basically, I always tell people that, look, if you cannot understand something, see, let's say I'm talking about stock markets, or let's say I'm talking about, what is the relationship of companies' earnings with their share price movement, right? Now, what happens is that a lot of times people cannot understand finance or stock markets or economics or numbers for what they are. But if you give them an example from another walk of life, or if you give them an example from another science, then not perfectly, but at least the two parallels can be correlated, right? So I'll give you an example. A lot of times people tell us, like, I was just talking to you, it came in our conversation that, a lot of times people say that if you tell someone that you should have gold in your portfolio. So 2 years back, the objection may have been that gold doesn't give any returns. Why do you want to own gold? You should only own equity. And today the objection could be either way. It could be that gold has gone up a lot. Why should I buy now? Or it could be that look at how Mr. Trump and US are behaving. Gold is going to go up a lot more. This is just the beginning. Correct? Now, what I always tell people is that in an asset allocation environment, you don't single out any asset class based on your experience of the past behavior of that asset class. So what happens is that I always tell people that how gold will behave on its own. See, if you just take a chart and keep observing gold price, then how that behavior of gold price comes across to you is not to be confused with the way we put gold in an asset allocation portfolio. So let's say if you observe gold prices and a graph or a chart of gold prices or returns of gold over the last few time periods, it will give you a certain impression. When I say that we are managing a fund with say 15% in gold or 20% in gold, and you say that, oh, but look, 2 years back, maybe you should have bought gold. Today, gold has gone up a lot. Why you're holding even 10%? Let's say you have that. So what I would tell you is that how gold behaves on its own is very different when how gold behaves as a 15% constituent of an otherwise 100% portfolio. So how gold behaves on its own is very different versus how gold will contribute or behave when it is 15% out of 100%. So in that 100%, let us say you have 50% in debt, you have 10% in retail InvITs. Let's say you have 5-7% silver, which is say silver arbitrage or something. Let's say you have long equity, you have equity arbitrage. You could have potentially foreign equity. So understood. Now, people will not be able to understand this, that what the hell are you saying? How gold behaves on its own is very different from how it behaves in an asset allocation portfolio. Some people will understand, some people will say that, but if I tell you that apply the principles of chemistry, and if I, instead of explaining to you all of this as finance or mathematics, if I just bring up chemistry and if I tell you that, look, is oxygen good for you? You will say, of course. Okay. What happens when you have, two H, like two hydrogen and one oxygen? So very good. It's water. So no, how can you conclude it's very good? Instead of H2O, if it becomes H2O2, it becomes H hydrogen peroxide. It's used for cleaning wounds. You can get burnt with it. Correct? So see how oxygen behaves on its own. How oxygen behaves when it is with hydrogen in water. And how oxygen behaves when it is part of hydrogen peroxide. You can't compare. You can't form one impression based on the other. So I always tell people that asset allocation is like chemistry. If you have oxygen on its own, what properties it demonstrates is not, and when you mix it and it becomes water, you cannot identify the very same properties. You cannot hold oxygen accountable for not demonstrating the very same properties what it was demonstrating when it was on its own. Because now it is in the company of hydrogen. No, it's not on its own. So how gold returns and how gold volatility will behave on its own versus how gold behaves in correlation with equity. Very different, because there are some other linkages out there. in fact, in an equity portfolio, if you have gold, what will happen is there are very high chances that when equity does badly, gold starts to do well and cuts the volatility of the equity portfolio. So many times, if I have 50-60% equity, it will give me equity return. But if I have 15% gold, every time equity does badly, it is quite likely that the 15% gold will reduce my volatility. And for many people, when they are participating in equity, they cannot digest the volatility. They'll get thrown out of the market. So gold on its own, you may have a different perception. But when gold is used as a volatility dampener for equity, right, it plays a different role. And you don't do that by forming a view of gold. You don't need to have an opinion of gold. You don't need to forecast gold price. You just need to understand that the way the world works is that if equity disappoints me, having some gold will cut the downside. And you don't hold accountable gold for just delivering return on its own. Because now it's playing a different role. It's not here for delivering return on its own. It's playing a different role. So, I try to just explain people with different. And if you don't understand this, there is chemistry in life also, right? For example, if I come to Delhi and I invite you for an evening out, you will meet Tidesh, you will be my friend, you will talk to me. But if I get my wife and I tell you, you also get your wife, you will not be the same person, right? You might be slightly different. The party will be different, right? So, so we have to, sometimes people don't understand bare bones, or it is not possible for everybody to relate to just the number and the math and the economics and finance. So giving examples from different fields might simplify things.
I just want to go back to one thing that you mentioned earlier, which was very interesting. So you said that markets may behave the way they would, right? But it's your portfolio, what you have in your portfolio is what matters, right? And you've also written about it, saying that you can't control the markets, but you can control your portfolio and the reaction to them, right?
Yeah.
Can you expand on this thought and give some one or two practical examples for the listeners to understand this better? Because I really like the way you explain this.
So see, just a couple of minutes back when I was bringing up examples of, the US economy, the US economic conduct itself, and, obviously things getting compounded with the geopolitics, war in West Asia, war in Europe, all of these things. Correct. And otherwise, India was not supposed to be directly impacted, but somehow because of Russian oil and the politics, we have also been pulled in. Right. So what is happening is that everybody is now on a crash course trying to do PhD about, how Mr. Trump thinks and how geopolitics would work and all these kinds of things. So I always tell people that, look, since if you're talking to me in 2025, we have to discuss Mr. Trump. But if we were talking 2024, we would be expressing our intelligence or understanding of coalition politics, right? If it was 2023, we might have been discussing Israel and Hamas and whether it will lead to a wider war or not. If it was early 2023, we might be finding out about Silicon Valley Bank and how it can potentially become the next Lehman crisis. If it was 2022, we might be expressing our concerns about $130 oil price, correct? So what I'm saying is that depending on the year and the month, sometimes we make presentation on market scenario. Depending on the year and the month, in last 26 years, I could have had, every year 2 different presentations describing the current market environment. But what happens is that the market is always doing what it is doing. For a different set of reasons, every year it falls 10, 15, 20%. Like you would say in Mumbai, to roj ka circus hai. Right? It happens every year, it happens. So the thing is that if you weave in everything we spoke, you better get accustomed to uncertainty. Every year there will be a different reason, but it's the basic nature of markets that when things are going well, market runs ahead of fundamentals. Then there is something which happens whereby the market starts going behind the fundamentals, right? You don't need to do PhD on a new topic every year. You just rest assured that next year there will be another topic which will come. Maybe 2, if you are unlucky or lucky, whichever way you put it. So every year we can't be doing PhD about a new topic. But yes, we can factor it into our understanding and our expectations that for a different set of reasons, next year also the market will show some volatility. And the year after that, and the year after that. So there is no end to predicting and forecasting. Some predictions and forecasts, they may come right. Some prediction and forecasts, they may come wrong. But at least it's better off that we adjust our portfolios to factor in for these things. That's why I said, if your portfolio is full of small cap, mid cap, sector fund and thematic fund, then Mr. Trump or no Mr. Trump, it could be because of tweet or it could be for some completely different reason. The fact is that your portfolio is, off center. I mean, it is quite risky. So if not this, something else is going to cause the accident, right? So that's why I tell people that, the risk is not in the market. The risk is in your portfolio. I'll give you a different example. In many parts of the country, when you go, we might sit down and order a thali, correct? And if you go to the south of India or east of India or coastal part of Maharashtra where I am, when you visualize, Dinesh, we spoke about power of visualization. So, you visualize a thali. In this part of the world, when you order thali, there'll be like this big plate and there'll be so many small containers, and in the center, the biggest thing you will find will be like, a lot of rice. That will be in the center, correct? And somewhere there'll be pickles and chutneys and those kinds of things also. So that's what will come when you order a thali. Now look at it this way, that that same thali you visualize, that in the place and the quantity where you have rice, you have green chili pickle. And in the place and the quantity where you're supposed to have pickle, let's say you have rice. So rice is replaced with spicy hot pickle, and pickle is replaced with rice, and in the same quantities. Now, if I consume that kind of thali, where rice is replaced with pickle and vice versa, if I consume that thali, and then I ask you, consume the thali, and I ask you, Dinesh, what do you think tomorrow? What's going to happen? So you say, bro, what's going to happen? I mean, you've eaten green chilies. You're not going to tell me, that, okay, don't worry, Mumbai ka pani mein amrit hai, everything will be fine. No. So it's like this. Your portfolio is what it is. You know that every year there will be volatility. Your portfolio has been made in a way that it cannot handle the slightest of volatility. So there is no point in worrying about who will do what when your own portfolio is, devoid of any balance. And let me say, what do I mean by balance? If you look at let's say there is a portfolio with 100% equity. What do we mean by balance? The biggest benchmark in the market is the BSE 500. Most of us flexi-cap, multi-cap, we follow BSE 500. BSE 500 is about, I would say, 70% large cap, right? And 30% small and mid cap. BSE 500 is 70% banking, IT, consumer, healthcare, maybe industrials. This is the lay of the land. This is what balance is for the market. But in my portfolio, I have 60-70% small and mid cap. And the sectors and themes I have is just 10% of the overall market, which is energy, defense, infra, etc. So you understood. That's why I said my portfolio is pickle and chutney. And I'm worried about quality of diet and what will happen in markets, etc. So that's the whole point. No point worrying about markets if your portfolio is structured the way it is. I mean, first you fix your portfolio.
Let's come to markets that we are witnessing today. I'm not saying it's bear market, but at least it looks like we are witnessing time correction, right? Just want to understand if I'm an investor. So when markets are doing really well, like we saw in 23 and 24, anywhere you invest, it tends to do well, right?
Yeah.
But you also said that money is not made in bull markets when it's going well. Money is actually made in markets which are not doing well. Just want to understand, why do you say so? And secondly, also in bear markets, right? Usually people are pessimist, right? Everybody thinks either bear market or let's call it a bad market. In a bad market, people are usually pessimist. You always say that equities reward people who are optimist. Right? So can you explain on this thought?
So, see, first of all, if you see, like say today, let's say when we are talking for say 12 to 14 months, like we said at the onset, the index has done nothing. Of course, 12 to 14 months back, index was all-time high. We've not been able to breach that all-time high, but the conditions were deteriorating. Today, the conditions are improving, at least domestically, but market is obviously at a slightly lower level. What people need to keep in mind, first of all, is that the beauty of the market is that for 1 year, if it doesn't change, it automatically becomes 10 to 15% cheaper, depending on the time and place you're talking about. So, if you see last 1 year, maybe if you look at index, high single digit earning growth. If you look at some of our portfolios, maybe low double digit earning growth. And on the background, if you see sovereign rating has been upgraded, interest rates are down, liquidity is high. So all said and done, 1 year back, 26,000 was, now we know it was expensive. But today we know it's not as expensive as it was, because obviously in 1 year automatically standstill itself, it becomes 12 to 15% cheaper because the fundamentals start to change. So this is one thing to keep in mind. Second thing is that, like you were mentioning about bull markets and bear markets, the thing is that in bull markets, your account statement looks good. Money is not made by investing in bull markets. Money is made by investing in bad markets or bear markets, if you will. Because when you invest in bad markets or bear markets and the market recovers, then that journey will get reflected in your account statement. So in bull markets, the account statement looks good. But money is not made by investing in bull markets. Money is always made by investing in bad markets or bear markets, or, not in euphoric times. This is something to keep in mind. Now, it's a bit difficult, but how to balance this? See, we all may have been on a roller coaster, maybe if you see Disneyland, or if you see here SL World, or, any of these places like Imagica or wherever, we've all been on a roller coaster, right? Now, Tinesh, when you are on a roller coaster, when the roller coaster is going up, up and up, what type of emotion you have? Let's say it is, at some point in time when the roller coaster is going up, you can even hear the gears cranking, and then it, goes up further. Now, when a roller coaster it goes, let's say you are in Hong Kong Disney. Okay, example. You can see the whole ocean, right? The roller coaster is going up, up and up. There's probably a cool breeze hitting your face. You with your wife or partner, you look at them and say that, great decision. Once in a year, we must come to this place. Thanks for getting me. If not for you, I wouldn't have planned this. Right? You're feeling nice, right? You're a bit high on life. You look around, you say, okay, once we get off from here, let's take one more ride. Or, let's go and have a meal there. Right? I mean, when the roller coaster is going up, these are your emotions. When you are at the highest point and when, you feel on top of the world, what happens after that?
The roller coaster goes down.
It goes down. So at the peak, when you should have been very happy and high on life, you should have actually been scared, no?
True.
Because when it's at the highest point, what happens? It starts to go down. When it's going down, what is your emotion?
You feel weightlessness and you get a bit scared if you're not used to it.
So then you will look at your partner and you'll probably say, I'm here because of you. I'm so scared. We are paying and we only are getting scared. It's just because of you that I'm getting pulled in here. Next time, please make sure that you don't force me to get onto a roller coaster. For God's sake, it's hurtling down to the ground. For God's sake, it stops and I get out of here and I'm never coming back. That's your emotion, right? At the worst point, when you feel that, the earth will split and this thing is just going to go in. At the worst point, what happens after that?
It starts to go up.
It starts to go up, correct. So when you are actually most fearful is when you should be starting to celebrate, saying that, okay, now it's over, it's going to go up. And when you are at the highest point, you should actually be fearful, saying that, oh my God, from here it is, right? But see what happens in investing. At the higher points, people want to invest more and more. They feel like, I'm the best fund manager on earth. At the low point, they feel, oh my God, we all are going to become dinosaurs. World is coming to an end. Right? I mean, I'm never going to invest in equity. Let the market recover. I'm taking my money. I'm going back to my village. Never investing again. Correct? So it's, again, I'm saying in all humility, it's easy to say, but it's difficult for people to practice. But then that is what the brownies are for. Correct? It is all for calibrating your emotion. I always remind people, we can keep on talking about the maths and the economics and the science. But the reality is that even the Nobel Prize in economics has been given to people who study human behavior. Correct?
Yes.
So why is it that way? Because economics and people's economic behavior is highly influenced by their emotions and their psychology. So that's why I said that money is not made in bull markets. Money is made by investing in bear markets. In bull market, the roller coaster goes up. Then your account statement looks good. The journey looks good. But from there, it can again, go back.
There's also one interesting or rather contrarian aspect which you say. You say that one should avoid investing lump sum in equities unless there is blood on the street.
Yeah.
Which is quite contrary to, let's say, what investor behavior is. In fact, even we have seen when markets fall, let's say 5 to 8%, we see a lot of people investing lump sum in market along with the SIPs that they're doing, right? People wait for such opportunities to invest lump sum. But you say that avoid lump sum unless there is blood on the street. So just wanted to understand, why do you say so?
So, a couple of things. One is that where does that notion come from? Actually, I subscribe to this. I don't disagree with what you mentioned, which is that, okay, you should have your SIPs going. Correct? And every once in a while, see, like I told you 2-3 times, if you take the past trend, it's factual. Maybe I'm repeating myself. It's factual that on an average, the small cap index has fallen every year once 20%. But on an average, in bad times, like 2020, it has fallen even some 50% or something. And in this year also, 2025, from the high point to the low point was 23% down. There are some years it may be double digit, like 12-15% down. Some years it is 30-40% down. But so let's say you are doing SIP small cap fund. When the market starts falling, you don't know how low it will go. But you know that by past experience that, small cap index falling 20-25% is not unusual. It has fallen many times. So if you have an SIP going and when the index has fallen, you don't know where it will stop, but from the previous high, it is say 15-20% down. Then you add a couple of more installments. That is part of your, that is just part of topping up your SIP, if you put it that way. But when you talk about lump sum, what happens is that I have seen that if somebody, there are two challenges which happen. If the market is low and you tell someone that, okay, look, this is March 2020, April 2020, things are really bad. And this is the time to start investing. So if somebody has 1 crore rupees at that time, either they will not invest or they will sparingly invest say 5-10 lakhs. Now in 2020 kind of environment, if you have invested 5-10 lakhs, in 1 year it would have become some 8 lakhs, 12 lakhs, 15 lakhs, whatever the number is. Correct? Then they will feel very confident and now the 50 lakhs will come. So now I think logically that in 2020, somebody has 1 crore. In 2020, he or she has invested 10 lakhs. That has given great returns. Based on that enthusiasm in 2021, they put 50 lakhs. This is very normal. Huh? This is why people fail to beat the index. And this is why that investor return is less than the return on the investment happens. It's not that at low levels, people don't invest. At low levels, people either don't invest, yes, that may be true, but they invest sparingly or they invest with a lot of trepidation. When they get rewarded for having made investment at a low level is when the big checks come. And the big checks come at a higher level is when the disappointment actually sets in. So that's why I always tell people that when you put big investment in lump sum mode, it's like, let's say you're going for, you're going boating or something, boating or rafting or whatever it is. The moment you put the boat out into the water is turbulent and you almost get thrown off. You will not enjoy the entire journey. You will always be on the watch. So let's say you put 100 rupees and the 100 becomes 80. Now that investment is on the watch forever. From 80, if it becomes 150 and again there it becomes 135, you're going to say, boss, this is the problem. I'm not comfortable with this. Let's get out of it. Every once in a while it is falling. So it's more about getting a smooth entry. Why I say sometimes don't put lump sum is just to ensure that smooth entry. If you have a smooth entry, you're likely to stay put. But right at the onset, if you have bad experience, then highly likely that you don't want to persist with that investment. That's the problem.
So one question about the principles, investing principles that we are talking about that investors should keep in mind is the concept of base rate, right?
Yeah.
So just wanted to understand how can investors use base rate for their decision making and how it empowers them.
So you should be mindful of, see a lot of time people ask that, am I always supposed to keep investing? Where should I withdraw some money? Because we keep telling people you should do asset allocation. We tell people that when the market falls, you should be able to top up your investment. So where will the liquidity come from? Right? Only when you get a disproportionately high return, if you reduce some equity, parked it on the side, only then you will have money to put it back when the market falls. So how to book profit, like when to book profit, just take an example. Or when to change your allocation, when to reduce equity and jump into something else. So see, we know that after liberalization in the early 90s, 35 year history is 14% compounded. So let us say that in the last 3 years, you've got some 25% compounded. Let's say in 3 years, money has doubled. At that time, you feel, see, I'm so smart. I made such a great investment. This fund manager is also good. I got into this fund at the right time. It's because of my excellent decision making that I've got these returns. So, well, yes, it is because of excellent decision making. But the point is that you got 60% more than what averages are suggesting. If long period averages are suggesting that equity investors should get 14-15%, and you got 25%. So, yes, you did great, but then it's not sustainable. These are the times, when you have got, and by the way, we should never forget that market generated 15% compounded or 14% compounded when the government was borrowing money at 8 to 9% and inflation rate was 5%. Today, government is borrowing at 6.5%, inflation is 3 to 4%. So why you should get 15%? So today, the base rate for equity investing should be more like 12%, 13%. And anybody who has got 18, 20% or 25% has really got handsome returns, but they are not sustainable. If the market has to align with averages, at somewhere in the future you are going to, and we are witnessing it, right? Till 2024, everybody was showing outstanding return. Now 1 year of zero return, the averages have started to, we are mean reverting. So this is why base rates are very important to keep in mind. That when you get outlandish return, don't attribute everything to your skill. Take some money off the table because the market is ultimately going to snatch it back from you. That is something to keep in mind. And we gave another example of base rates, right? When I was saying about balancing the portfolio. If you take BSE 500 is 70% large cap and 30% small and mid cap. And I told you how the lay of the land is and how the sectors are. If your portfolio is completely disjointed from the market and you get a high return, then you should know that the market will mean revert and your high return is ultimately going to become mediocre return unless and until you accept that you have got disproportionate return and take some money off the table. Till last year, the defense index, defense is top of mind. There is a PLI for defense. The government is talking defense indigenization. All of that granted. Perfect. But till very recently, the 5-year CAGR of defense index was 60% compounded. 5-year CAGR 60% compounded, meaning it has doubled every 16 to, it is probably doubled every 17, 18 months or something like that. Right. So, see what is happening in US, for instance. The top 7 stocks are 33% of S&P 500. Even in the tech boom, it was barely 12 to 15% of S&P 500. Right. So these are examples that you should keep in mind some base rates. 7 companies don't become 33% of the entire world's biggest index. Right. AI will be, in the real world, AI will be very big in the next 5 to 10 years. But the market has already probably done and dusted it, right? So that's why base rates are very important to keep in mind how things have behaved in past and where they are right now. Is it getting totally outlandish or off center? Those things you should be mindful of.
Let's say if I'm an investor, right, and I want to invest in mutual funds. So what are those 1, 2 or 3 things that you think are the most important factors when selecting a fund for an investor?
See, if you are somebody, let's say if somebody needs to listen to our conversation to understand how to select a fund, I would assume that they are not like an expert or experienced investor. I would assume, and I would answer from the perspective that you are beginning your journey or in early stages of your journey. So then, the first thing that you should do is that, just look at diversified funds. Okay. Don't start with, okay, what is doing well now? Let me buy gold, let me buy this, let me buy that. Either buy a hybrid fund like multi-asset or balance advantage, or buy a diverse. So 100% equity, just buy a diversified fund like flexi-cap, multi-cap. You're not 100% equity, you are somebody who cannot take the volatility, you want to take small steps, just buy multi-asset or balance advantage. Right? That is how one would start. In simple terms. And you don't need to buy every fund or you don't need to buy the latest fad or anything like that. Once you are seasoned and you become an aggressive investor, or when you feel that, okay, you can take a risk, you can venture out, you can try more, then you try to figure out, okay, sector fund, thematic fund, what can give a very high return, and what can outperform the market by a mile. All that things comes later. My simple 2-point thing is, equity investor, go for diversified, flexi-cap, multi-cap. Risk-averse investor, go for multi-asset or balance advantage. That's it.
These days, if you look at discussions on mutual funds, right, this topic invariably comes in about X fund holding this much cash, Y fund holding that much cash. Okay. So I just wanted to know your views. What's your stance on whether fund managers should hold cash in their portfolio or they shouldn't?
See, my personal opinion is that we are supposed to beat we're supposed to beat the equity benchmark by being in equity. Correct? If I beat the equity, if I say that, okay, I outperform the equity benchmark by a mile, you say, how? I say, I didn't invest in equity. To me, it doesn't sound right, because, markets are not forecastable in that sense. Like, you may be like, look at the last few weeks. You may be sitting on 20% cash and the market is starting to, go about 25,000, right? So, and not just cash calls, any exaggerated calls. Like, if you ask today, people who don't know anything will also say, tech is not going to give any return. But tech is 9% of the benchmark. If you're underweight or if you can't find any ideas, you struggle to find ideas, you might be 5-6%. And if you're very bullish, you might be 12 to 15%. But given that something is 9% of our market, and you say it won't work, make it 0. So I am not a fan of, given that we spoke so much about uncertainty, dealing with uncertainties and dealing about probabilities, you automatically understand that I am not somebody who's a fan of making binary choices. Correct? I think consistent performance, binary choices is anathema to delivering consistent performances. That is something that you should keep in mind.
So before we end, just one last question. What is that one thing that you will tell investors, one takeaway from this conversation?
So I'll be quick and I'll make it 2 things. See, first is, just repeating, there's a lot of math, science and economics out there, right? But never forget that even the Nobel Prize in economics was given to people who study psychology and behavior, which means that the math, science, economics and finance is very important, but it all comes to a zero if you cannot control your emotion and your,
your behavior,
how you conduct and, how you behave at crunch periods or even otherwise, right? So behavior and emotional control, very important. And second is, because we speak a lot about investing, I think, what we're talking about, saving, investing, there's all financial investing. I think all of this will become relevant only first if you have invested in yourself, right? So you need to make, whether it's your education, whether it's your personality, your career, right? If you invest in all of that and make great out of the opportunities that are there with you, then the financial investing is what will actually be rewarding and be of some consequence. So when we're talking about investing, I think investing in yourself, that comes first, and then the other part can actually become rewarding.
True, very true. Thank you, Aashish. Thank you so much for joining us, and thank you for this lovely podcast and conversation.
Thank you. Thanks for having me. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.